Artificial intelligence, once the realm of science fiction, is now reshaping how business, government, and everyday life operate. In 2025, companies are funneling hundreds of billions of dollars into building AI infrastructure. But beneath the excitement lurks a question. Are we riding a golden wave or building a dangerous bubble? Today we unpack the global AI boom, the warning signs of overreach, and what it could mean for jobs, economies, and society. According to multiple sources, global spending on AI infrastructure, from chips to data centers to cloud systems, has surged in 2025. Blockchain News +2 Wired +2. These investments are not small scale. They underpin the backbone of modern AI services, large language models, generative AI workloads, and cloud-based computing power. Harvard Business Review +2 The Money Beat +2. Some analysts say that this wave of investment has become a significant driver of U.S. economic growth. AI-related capital spending contributed over 1 percentage point of U.S. GDP growth in Q2 2025. BlackRock +2 The Washington Post +2. In short, AI is no longer a niche side project. It's now deeply woven into the global economy's core infrastructure. But that rapid rise raises new concerns. Signal, overvaluation, and speculative frenzy. Many financial analysts and economists warn that market valuations tied to AI may have raced ahead of real returns. A 2025 piece in The Atlantic argues that much of what's fueling the AI economy is expectation, not necessarily productivity gains yet realized. Investments, debt, and overexpansion. To build the data centers and infrastructure needed for AI, many companies are not just using cash. They're issuing debt, building massive physical infrastructure often years ahead of actual demand. That mismatch, high upfront cost, uncertain long-term return, is a classic hallmark of a bubble. Some experts warn that if demand plateaus or fails to grow as expected, many of these investments could become stranded assets. The winner-takes-all dynamics. Some prominent voices liken today's AI race to prior tech bubbles. As noted in recent coverage, many leaders believe only a handful of large players will survive, while most others may fail or be absorbed. This dynamic could lead to extreme consolidation, stifling competition and limiting innovation to the biggest firms. Risk: job displacement on a massive scale. A recent report from the World Economic Forum estimates that nearly 980 million jobs worldwide face high disruption risk in the next few years due to AI and automation. Another 2025 labor market study finds that automation AI systems tend to erase employment and wage growth for low-skill occupations, while augmentation AI benefits high-skill jobs. The result? Experts warn of a coming AI precariat, a large class of workers who lose stable income and struggle to find new work, especially among relatively low-skilled or routine task jobs. Potential: new jobs, but unevenly distributed. Not all is doom and gloom. AI's expansion does create new opportunities in data center construction, AI system maintenance, algorithm development, and augmented white-collar work. But these new jobs tend to require specialized skills, technical training, or education, which many displaced workers may lack. That raises tough structural questions. Can economies reskill fast enough? Will new jobs replace old ones, or just shift the inequality? Global market concentration and vulnerability. AI-related firms, particularly big tech, now account for a substantial share of market value and stock market growth. Some estimates suggest AI-related stocks have driven 75% of the S&P 500's gains, and a large share of corporate investment growth since 2022. That concentration creates systemic risk. If confidence falters, a large drop in AI-linked valuations could ripple across global markets, hurting pensions, savings, and institutional investors alike. Debt overload and overcapacity risk. Many AI infrastructure bets are financed by debt. If demand slows, companies may struggle to service that debt, leading to defaults, fire sales, and financial instability. Additionally, if data centers and chip farms outstrip demand, we could end up with vast overcapacity, expensive to operate, difficult to repurpose, and costly to maintain. That's a big risk not just for tech firms, but for entire economies reliant on tech investment. Misaligned time horizons. Software versus infrastructure. AI software, new models, services, apps, evolves rapidly. But building physical infrastructure like data centers, fiber networks, and power supply takes years. That timing mismatch means companies may complete infrastructure long after the hype has moved on, making those investments obsolete. This lag creates a dangerous scenario. When the market cools, entire swaths of infrastructure could sit idle or become unprofitable. If the AI boom turns into a bust, even a sharp correction, consequences could be widespread. Global stock markets could tumble, wiping out trillions in value, hurting retirement accounts, investments, and savings. Massive job losses, especially for workers displaced by automation without alternative employment paths. Corporate debt crisis, as firms scramble to service debt on infrastructure that no longer yields returns. Supply chain disruptions, especially if production and services had become more automated, centralized, and dependent on AI-powered systems. Widening inequality, as high-skilled workers and capital owners capture gains, while lower-skilled workers bear the brunt of disruption. Some economists argue deeply that such a collapse could reduce GDP, shrink consumption, and push countries into recession. Regulated, smarter deployment. If firms and governments emphasize augmentation, AI to assist humans, not replacement, the disruption may be smoother. Some economists suggest complementary AI, where AI boosts productivity with human labor, not instead of it. New social contracts and policy responses. Proposals like AI capital taxation, universal basic income, UBI, or funding for retraining could help cushion workers from displacement. Some academic models even suggest AI profits could theoretically fund modest UBI under certain conditions. Diversification and global collaboration. If countries invest in broader education, green energy, digital infrastructure, and equitable AI governance, the wealth from AI could help fund new public goods rather than enrich only a few. Selective, sustainable growth. Not all AI applications are equal. AI used in healthcare, energy, climate modeling, education, where human creativity and oversight remain essential, may deliver lasting value without mass displacement. Watch markets for signs of overvaluation, high debt loads, frequent corporate bond issues for AI projects, and data center overcapacity. Push for transparency and accountability. Demand companies and governments disclose how AI investments are funded, what jobs are created versus lost, and what long-term plans exist. Invest in human capital and reskilling. As automation threatens many jobs, skills in AI management, ethical oversight, caregiving, creative arts, maintenance, and human-centric services may become increasingly valuable. Support policies that share AI's gains broadly, from progressive taxation on AI profits to social safety nets for displaced workers. Encourage responsible AI deployment. Prioritize uses where AI augments rather than substitutes human labor, especially in critical sectors like healthcare, education, environment. The AI boom of 2025 has unleashed extraordinary promise, but also serious risk. At its best, AI could drive innovation, improve lives, and boost productivity. But if current spending and speculation continue unchecked, we may be heading into a bubble whose burst could trigger massive economic and social shockwaves. The choice now isn't whether AI happens, it's how it happens. Will we build a future that balances technology with humanity, or one where rapid automation upends livelihoods faster than we can adapt? For workers, for policymakers, for every citizen, The time to ask those questions is now.